Good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. So my name is Benjamin Goh, the Head of Research and Investor Education here at SIAS. With me today is our Senior Technical Analyst, Sunny So. We're going to be going over a couple of updates for the capital markets. Before we do that, the disclaimer is that obviously SIAS is not it's not licensed by MAS. We are a registered charity. So whatever we talk about today, especially for specific stocks or companies, can be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the stock market. Couple of announcements. The next RCR session is on the it's actually this week, right? Wednesday is for the RCR session for August. The next one for September is the 30th of September at 7 p.m. So as usual, use the QR code to chope your seats. I forgot to mention that this is exclusive to members, SIAS members only. Again, we are using Google review. Do give us a 5-star rating. Just so that we can tell our boss we got a 5-star rating and full stop. Okay, so that's if you like us. Again, use the QR code. This is if you are not currently a SIAS member, do sign up. It's going for $1 per month, which is $12 per year, so relatively cheap. Use the QR code to zap that. Okay, let's get started on today's content. I've got 3 charts I want to go over. Firstly, we've been talking a lot about how the second half of 2023 is going to be better than first half, so on and so forth. We are seeing some light at the end of the tunnel. So 90% of the S&P 500 component stocks have already reported their numbers for this cycle. We're talking about the second quarter numbers. So if we take the second quarter numbers, actual reporting, plus the consensus estimates for the rest of the 10% that has not reported, we come up with a blended estimate for what we think may happen, or what we think is going to happen. So as you can see, right, the net income for the S&P 500 excluding energy is estimated to gain 2.1% year on year. This is doesn't sound like a lot, but actually the consensus estimate before heading into the earnings cycle or earnings season was for a negative 3.3% year on year. That means the consensus estimate was for a decline, and we're talking about net income here. So this is all good, right? So, and this is obviously after taking into account some of the one-off charges from some of the large companies, for example, Merck, the pharmaceutical. So even including all these one-off charges, the estimate is for a gain of 2.1% year on year. So this is the first gain since the first quarter of 2022, which is great, right? Because we've had 16 months of elevated inflation and elevated interest rates. We are now heading into the second half of 2023. Our base scenario in January was in the second half would do better than the first half. So this is the light at the end of the tunnel a little bit. So our take is that we are close to the inflection point, close to the trough, the end point, and then when we head into Q3, Q3 and Q4, then things will get much better. So this is all good. Why X energy? Simply because if you look at the white color line here, energy net earnings have been in a decline. It means negative. For estimated to be negative. All right. So, but if you look at, or rather it's positive right now, but it's estimated to go into negative territory in the next 2 or 3 years, simply because of structural issues in the economy, and of course a little bit more volatile. So if we take that out, you look at the orange color line, that's where we have the X energy, and as you can see right now in the second quarter is now in positive territory and is expected to stay in positive territory right up to end of 2026. That's where the estimates end. So this is green shoots, ladies and gentlemen. So all good. Next, another piece of good news coming out of the US. As you know, the Fed is actually made up of I can't remember, but I think it was 12 regional banks, right? So the Federal Reserve is made up of, I think, 12 regional banks. So one of the more I guess more in terms of processes, more developed, the Atlanta Fed, have got a GDP modeling tool. It's called GDP Now. The forecast is for a estimated 4.1% GDP growth in the US for the third quarter of 2023, mainly driven by investments as well as capital expenditure, which is pretty good news, right? But this is, of course, in Q3 and is not annualized. It's year on year. So obviously, we're not going to have a full year of 4.1%. But again, another piece of anecdotal evidence that the US economy is not as bad as it looks at. On the right hand side of the chart, or rather, if you look at the is this orange line and the legend on the right hand side of the chart, the axis, does show that the 12 months forward revenue revision momentum stands at a positive 0.4. Okay, so let me just elaborate and define this. So the Fed actually calculates, or rather, it tries to quantify what you call a forward revenue revisions. That means how many times the strength as well as the frequency of revenue being revised upwards or downwards. All right, and then it calculates a momentum out of that. All right, so anything which is a positive or high positive is generally good. So it means that companies generally will be revising their revenue upwards and higher, magnitude and frequency. All right, so and this is 12 months forward looking, so it's not current, it's not spot, it's not historical. So as you can see, the line is actually quite nice, because it's been kind of either flat or below zero for the last few months. The August reading was actually a positive 0.4, which gives or supports the narrative that upwards revenue revisions is gaining momentum. So again, it feeds into the narrative that the US economy is, pulling out. Okay. So the good thing is that the net revision momentum was positive for the last 3 weeks already, and for all sectors excluding communications. So that's all good. Communications obviously is a defensive company, so may not move as fast. But for all other sectors, the other 10 sectors, they're all good news there. Now, obviously, good news needs to be mixed a little bit with some common sense. I want to focus a little bit on the U.S. tech sector. So, U.S. tech sector, obviously, names like Nvidia, Microsoft, AMD, to some extent, have been running ahead of the rest of the pack since the beginning of this year, simply because of the Chat GPT mania. And we want to address that. So if you look at the left hand side, and let me see, can I annotate this? Yes, if you look at the left hand side, the last time the Fed funds target rate, or just think of it as the interest rate, was above 5% in the US was the year 2007. At that point in time, the forward PE ratio was 19 times. That means the forward looking PE ratio was 19 times. Now the year is 2023. The Fed funds rate is still above 5%, but the PE ratio, or forward PE ratio, for the US tech sector is 27 times, or very specifically 26.7 times. As you can see, is about 7.7 times more than what it was back in the year 2007. Obviously very rich, very lofty, very frothy. And the whole issue is, of course, it's a bit overvalued, not a bit, but quite a fair bit overvalued. So we're bringing this up simply because, as you can see, the economy as a whole in the US is getting better. Earnings are getting better, yeah. But specifically for the US tech, because the PE ratio is so high, earnings need to catch up really fast, really quickly, in strength, and to justify the PE ratios. So if the next 2 or 3 quarters that doesn't happen, then obviously there's going to be a little bit of moderation in the US tech sector. So specifically for the big 4 or 5 tech companies, they are at risk of having the price moderating or even correcting if the earnings don't show up to support the high P ratios that they currently have. All right, so Nvidia is of course a big culprit of this. The stock price has gained so much since January. Microsoft, AMD to some lesser extent. So those are the companies that you want to watch to kind of make sure that the earnings do catch up with the P ratios going forward next few quarters. If not, there'll be trouble. All right, so thank you very much for that. I'm going to hand over the time to Sunny, who is going to read the tea leaves and tell us about the technical side of things.
Okay, thanks, Benjamin. So as usual, I'll just go through the data of what happened last week on the macroeconomic or the economic front. We have on Thursday, 10th of August, one day after our National Day, the inflation rate coming out at the headline numbers month on month was 0.2, which was in line with the previous month reading as well as the consensus. But on the year-on-year reading, you can see that the actual number came out at 3.2%, which was 0.2% higher than the previous month reading. However, it's a 0.1% lower than the market consensus. So this was sort of a mixed kind of data because it shows that inflation is getting a bit sticky. It was higher than the previous month. However, it's not as bad as what the market analysts are expecting of 3.3%. So core inflation also in line with consensus and previous month reading, but the core inflation, which exclude the volatile food and energy prices, came in at 4.7% year on year for July, compared with the previous month reading of 4.8. So this is a positive reading compared to the previous month and also a positive reading compared to the analyst estimate as well. So overall, this data, I would say the inflation numbers that came out is a positive news for the stock market, at least because it shows that at least inflation is still under control. It's not going to spike back up very strongly. However, it's still a bit sticky right now, but then it's showing sign that core inflation is coming down slightly, but the headline numbers may stay higher for a while longer. So market actually cheered on the inflation data announcement, and then actually you can saw that there was a bit of a pickup in the stock market the midweek of last week. But towards the end of the week on Friday, where we see the PPI numbers came out, the market actually went down again. So what happened was the actual number came out was 0.3% for the PPI month of July. The previous number was 0% and market consensus was 0.2. So it came in above the previous month number and it came in above the market consensus. So what does this mean? The PPI data measures what the wholesalers or the manufacturers pay for their raw materials, and this could further down the road translate into higher prices for the end consumer. So this is a sign or a forward-reading sign that inflation may continue to stay at an elevated rate going forward. Hence, there was a pullback in the stock markets towards the end of the week last week on Friday. Okay, so I'll go to the charts later on to see how much of a pullback was there on Friday. But before that, let's look at the CME Fed Watch 2 first, which calculates the probability of the Fed rate hike going into the next meeting, which happens on 20th September. So the latest reading that we have, the probability that we will not have any rate hike, we will have a pause. That means the interest rate will stay at 5.5%. The probability now stands at 88.5%. Okay, this comes after a correction from the previous day or Thursday reading of 90%. So the PPI data actually brings down the probability of a rate pause by 1.5%. So nonetheless, it's still a very high kind of a probability percentage rate that we are not going to see any hike in the 20th September meeting, which could provide, if this happens, this could provide another catalyst for the stock market to push even higher from the first half of this year. Okay. So let's look at the charts now. So this is the Dow Jones Index chart, as you can see over here. Last Friday, the Dow Jones Index was up 0.3% compared to S&P 500 and the NASDAQ Composite Index, which was both turning negative. So now just to recap a little bit, remember a couple of weeks back, we have the special WMR session with Tiger Fund Management CEO saying that the rally that he sees from the first half of this year, which was mainly tech and AI-led kind of a rally, is actually expanding and spreading to the other sectors of the market. So this is one of the signs that I'm seeing because the Dow Jones Index, which was the top 30 companies in the US, has recorded a positive number on Friday, whereas the tech-heavy NASDAQ has a negative number. So this is one of the signs of what he's saying. So the Dow Jones Index the past week has a bit of a pullback, as you can see over here. It was testing this level over here, which is the 35,492 points, which is the 35,500 level, I would say. This was the high that we saw here in April 2022 last year. So this is a bit of resistance for the Dow Jones Index. It has a bit of a pullback. However, you can see that the 20-day moving average, which was the basis of the Bollinger Band, is still pretty much supporting the Dow Jones Index. Okay, so last Friday, we managed to close just slightly above the Bollinger Band basis of 35,264 points. So that means that the short-term uptrend above the 20-day moving average is still intact. Support level to look out for Dow Jones Index, the first one will come at the December high of last year, which is around the 34,700 points level. That will be the first support level for the Dow Jones Index, which also may coincide with the lower bound of the Bollinger Band, 34,600. So there is some support over here. And slightly further down, this straight line over here, which used to be a triple top resistance level, may have a change in polarity and becomes a support level for the Dow Jones Index at 34,200 points. So a lot of a support level very close by for the Dow Jones Index. Any further pullback, I would say, in my opinion, not a recommendation, would be an opportunity to get back into the market for the Dow Jones Index at least. Now, on the uptrend that we see since the beginning of the year and even from the low of last year, October, if you connect the low of October last year with the low of March this year, you have an uptrend line. It was tested in May this year. It is still intact. And this time around, if there's a pullback towards the triple top that I say over here, the red line, 34,200, that would be a very strong signal for traders and investors to get back into the Dow Jones Index, because it has shown before that this uptrend line is still a pretty strong and intact kind of support uptrend line that we are looking at. So if it comes to this point over here, 34,200, it will definitely be a strong sign to get back into the Dow Jones Index. Short-term wise, in the next couple of days or even the next couple of weeks, I would say you can see that the MACD indicator and the RSI is pretty negative. MACD reading is negative, no doubt. But then this negative momentum that you see with the negative MACD histogram bar is starting to subside as of last Friday for the Dow Jones Index. So that means that the downside may still have a bit of momentum, but it's subsiding. Hence, if it comes to a certain level around the 34,200 or the 34,600 level, you can expect to see a bounce. The RSI is also not too bad. The latest reading last Friday was at 56.92, which is still above the 50-point neutral mark, thereby saying that the retracement or the pullback or the correction that we see so far in the past 1 week is not that bad or not that strong in the negative momentum, and hence may still have a chance to recover once it hits a certain support level, whether it's the December high or the triple top that you see over here at 34,200. Okay, so that is the Dow Jones Index, which is the top 30 companies in the US. Next, we move to the broader index, which is the S&P 500, which has a negative a reading on Friday, down 0.11% or about 4.78 points. I would say it's kind of a flat kind of a performance on Friday. But as you can see here, for the past 2 weeks, the S&P 500 have pulled back quite a bit. The first sign that I'm reading from the chart of the S&P 500 would definitely be the 20 days moving average, where it broke below that somewhere towards the end of the week the week before last week. So this is a sign that in the short term, kind of a run upwards in the first half of this year is losing much of its momentum. So the short-term uptrend, where I'm connecting the low of March as well as the May this year, we have a short-term uptrend over here, which will be the first support for the S&P 500, and that might also coincide with the double top that you see here, which is around the 4,400 points level, and just slightly below that, the lower bound of the Bollinger Band, 4,430 points, would also provide some support along with this uptrend line that you see here. So this is the first support that I'm looking at for the S&P 500. For the next support level, this would be the uptrend line between the October and the March low of this year, which will likely be around this level. I would say is a triple top resistance level again. So I just change this color into a red line first, okay? Meaning previously it's a resistance level, so 4,200 might be the next support that you're looking at for the S&P 500. And then gauging from the MACD indicator and the RSI, it's still a bit hard to tell, because looking at the MACD indicator, the negative momentum reading is actually quite strong, and the RSI has put below the 50-point neutral mark, now reading at 45. So that means that this support level that I see over here connecting the March and May low may not be able to hold on, and hence it will be more of a conservative kind of opinion that we should get back in around the 4,200, which is the triple top resistance level, and that may find a confluence or coincidence with the longer term uptrend line connecting the low of October as well as March this year. So S&P 500, I think we have to wait a bit more longer before we get back into the S&P 500. Next, let's look at the tech-heavy NASDAQ Composite Index. It has broken below a key resistance level and did not have a change in polarity to become a support level. So this is the level of 13,800, which was broken below. last week, and hence we find a bit of support towards the end of the week on the short-term uptrend line connecting the March and the May low for the NASDAQ Composite Index. So is this short-term uptrend line likely to hold? According to the indicators, it does not look likely that it is likely to hold because both the MACD line and the Seng line does not seem to be converging and does not seem to signal to us that the downtrend momentum is subsiding. Hence, it looks more towards the expanding of the downtrend momentum for the MACD indicator. The RSI has dropped 10 points below the 50-point neutral mark, the latest reading at 40.11. It's also 10 points away from the 30-point oversold trigger. So only when that happens, I would have more confidence in getting back into the tech-heavy NASDAQ Composite Index. And that could be around the support level that you see over here, which is maybe the green line, okay, which is a double bottom that you see in early part of last year, 2022, or even a double top resistance that you see this year around the 12,200 level. That would be also a support coming in for the NASDAQ Composite. So I'm seeing that support level coming in from 12,500 to 12,200 for the NASDAQ Composite Index. And I expect the pullback to carry on a bit longer for the next couple of weeks before we see some kind of a rebound coming in, which more or less coincide with the dates towards the 20th September Fed rate announcement, which could be the catalyst to bring back up all the three major US indices. Okay, next, let's move to the Asia side. Just some key news today. I hope it's reflected over here. So I think Country Garden was very badly affected, and there's the news is developing right now that the developer may have gone under, maybe going to go under, or maybe under severe debt pressure, and they are going to report that the first half losses amount to billions of dollars, and there are some bonds that are due for Country Garden's developer that they may or may not be able to pay back. So that's a question mark for now, and the news is developing. So we are waiting for more clarity on that. But as you can see over here, the Hang Seng Index have a gap down today. So I'll just repeat what I have been covering on the Hang Seng Index for the past couple of months. I say that Hang Seng Index is reaching a support level during the March low. I actually mentioned here that I actually get in. So my target was actually the year-to-date high, which is around the 22,000 level. Of course, it went up here, did not really reach my target. So I'm still holding on to my Hang Seng Index. And then once it reached this level again, I actually get back in around here and around here as well. So past 1 month, I would say the Hang Seng Index was pretty okay. And then there was a bit of a pullback because of some macroeconomic news that the China economy is not performing as well as what is expected, and the stimulus has not been forthcoming yet. So probably this round again, so we have a gap down here. To me, it's an opportunity again. So I would probably accumulate around this double bottom again at the 18,300 level. So I think investing sometimes is a patience game. So we have to, if let's say, even though we get back into a sort of a nice and comfortable position, we may not see the profits or the returns immediately, but we need to have the patience to hold it on to reach our target. So that is my take on the Hang Seng Index. As of now, if it's going to come back lower here, I will be adding more to my position in the Hang Seng Index, and I'll update you along the way every week to see how the Hang Seng Index is moving going forward. On the STI, I record last week on the WMR that we say that for the uptrend of the Straits Times Index to continue, we need to stay above the critical 3,300 points. However, last Friday or even last Thursday, we have sort of a gap down of the STI Index. That means that the short-term uptrend that we see over here is no longer valid, and the STI is now under severe kind of pressure. Okay, so as you can see reflected in the MACD indicator, the divergence of the MACD line away from the signal line is expanding, thereby signaling to us that there is more downside to the STI index right now. So two reasons I attribute to this. One is, of course, the Chinese situation, the Chinese developer situation. The other one is the PPI index, the PPI reading index that came out last Friday, which caused the gap down that we see in the STI index. So these are the two main key reasons I see for the pullback in the STI index. So the RSI indicator is also below the 50-point neutral mark in the RSI now. We are still 10 points away from the 30-point oversold trigger. So I'm waiting for that to happen, and that could happen maybe around, the first one will be the December low, which is around the 3,225 points level. Slightly below that, 3,200 is the lower bound of the Bollinger Band. And then, of course, you have this low over here somewhere in the beginning of July before we see that rally in the whole month of July. That's the 3,128 points level. But overall, I think the STI index, I am still quite confident if it comes to the 3,200 point level, the lower bound of the Bollinger Band. I think that could be quite a major support. And if that coincides with the RSI hitting the 30-point oversold mark, I think traders and investors will come in and support the STI index again. So I'm looking at 3,200 to be the key support for the STI index. So that's all I have for this week technical updates. Anything else to add, Benjamin?
No, thank you very much for that. So as usual, very illuminating to see the charts and also the narrative behind it. Okay, so ladies and gentlemen, this week is going to be a little bit choppy, it looks like, simply because of Country Garden, and because the earnings season is largely over. There's no news to print, so they're going to print some bad news like China or Ukraine. So that's how it goes. All right, so thank you very much for joining us. Do join us for the SIAS session this week if you're a member. If not, do sign up. Thank you very much and have a good week ahead.